Okay, hello everyone. Our today's topic is to give you the confidence about the restructuring. So the topic name is restructuring, and this is a very important topic, practically as well as from the perspective of AFM. Practically, if you work in some big four, investor banking, you may have to encounter this topic while doing the consultancy for any loss-making company. If if there is a company that has a history of profits, but in recent time that company has went into losses, so now you have been hired as a consultant and they are demanding your advice that you should give them the advice that how you can make that company into a profitable company. So before telling you that how examiner can test this topic in the exam, I want you people to aware of few of the terms. You should know those terms. You should remember those terms. That can be tested in exam in a very easy way. For example, you should know that what is I will talk about all the terms. What is debt equity swap? Okay, you should know that what is divestment. You should know that what is demerger. You should know that what is spin off. In past terms, spun off. You should know that what is carve out. Carve out. CARVE, carve out. You should know that is what is MBO, management buyout. You should know that what is MBI, management buy in. These topics can be tested straightforwardly in exam. So you should know the definition of divestment. You should know the definition of the demerger plus the advantage of the demerger and the disadvantage of the demerger. So what is the advantage? Advantage is you will more focus on the individual part. Efficiency of the business will increase. Accountability of the management will increase. Management will be more responsible. Management will be focused on the main activities of the business. But disadvantage is you will lose the economies of scale, economies of scope, bargaining power will gone. Plus, there is a threat of acquisition. Somebody else can acquire you because your size has become smaller. So demerger advantage and disadvantage. It can be tested in exam. Spin-off definition, carve-out definition, and difference between these two. Difference is in spin-off, you will separate a division from your group and make it a separate listed entity, and you will issue the shares to the previous owner. In carve out, you will separate the division from the business and issue its share to the public. You will retain some of the shares with you and you will issue remaining shares to the public. So in carve out, you will raise money. In spin off only, management will change. Ownership will remain same. In carve out, management will change, but the owners will also change. You will issue some shares to the public, so you will receive some cash. So in MBO, management buyout, you should know the parties to the MBO. Who are the parties to the MBO? Management, banks, venture capital. So management will buy its own company, but management doesn't have that much money. So venture capital will put equity, management will put equity, and they will borrow from the bank. They can also borrow from the venture capital, but mainly they borrow from the bank. So you should know who are the parties to the MBO. You should know what are the advantages and disadvantages for previous company, for the seller, as well as for the management. You should know this. It's very important. It can be tested straightforwardly in exam. You should know this. Then MBI, same advantage and disadvantage. All the advantage and disadvantage will be common, except MBI will be for the external management, MBO will be for the internal management. So this can be tested in theory in exam. Okay. So now, what is a numerical that can be tested? Number one, debt equity swap. I have written it above, but it can be tested here. Debt equity swap. Maybe you are a debt holder. Company is going into restructuring. And now the management is demanding that your debt will be converted into equity. Aapka debt is now going to shift into equity. Will you accept that? You have to compare it. So how you will compare? You will compare market value of equity with market value of debt. So if market value of equity is 1,000 and market value of debt is 1,000, debt holder will never accept this, because the risk of debt is very, very low compared to the risk of equity. Equity risk is high. Today, if I buy a share at $100, maybe in seconds, it can move to $70, $50, $90. Like in some of the stock markets, it can go up or down like 30%. In some markets, it go up or down by 7.5%. Like in Pakistan, it's a rule that market will can change by 7.5% in a day for equity market. Okay. So debt equity swap, in debt equity swap, remember, you can't exchange 100 or 1,000 million of debt with 1,000 million of equity. 1,000 rupee of debt with 1,000 rupee of equity. Equity is extremely risky. The debt holder will only accept equity if you give it like something for the risk compensation. So if you offer 1200, 1300, 1500 equity against that debt, in that case, maybe debt holder accept this. Might be debt holder accept this. Use these two words in the exam because it is not guaranteed that they will accept. Yes. In case of, like in other choice, debt will not be recovered. They will only recover 600. In the second choice, company is going to give them 1500 for 1000. Okay, that is a good choice. For example, one scenario, your debt is 1000, but you will receive 600. In second scenario, company is giving you equity. So that is risky. But company is giving you 1500 equity for 1000. Okay, instead of receiving this may be the good case. At least we do not have to record the bad debt. So in that case, debt equity swap is acceptable. Otherwise, not. Okay. Next is you have to record the impact of transaction on forecasted EPS and balance sheet. Forecasted EPS and balance sheet. So depend which balance sheet. Current balance sheet or forecasted balance sheet. So let me make a scenario for you. So I am writing proposed income statement. Better word is forecasted income statement. Forecasted balance sheet and current balance sheet. Obviously, these two cannot be tested combinedly. So let me make a line in between. Okay. So what type of transaction can be tested? For example, in forecasted income statement only EPS will be given. Forecasted EPS will be given. In balance sheet, complete balance sheet will be given. So let me quickly write the balance sheet. So I'm writing balance sheet item for both these two. Assets, non-current assets, current assets, total assets. In equity, share capital, reserves, retained earning, non-current liability, current liability, equity and liability. Okay. Now, number one transaction that can be tested. Okay. Forget about this. Let's talk about this case. Maybe examiner will say issue new share. Okay. Obviously, you will receive funds. Invest in non-current asset. Okay. And you will get a return on asset is 10%. So what is the impact on forecasted EPS? Anyone? What is the impact on forecasted EPS? Return on asset will increase the EPS. increase in EPS, right? 10% on assets. If it is after tax, then you will do nothing. Simply take the percentage of 10%. Otherwise, what you will do, you have to do the after tax. So this will be, you will write here current forecasted earnings. Okay, current forecasted earnings. Revised earnings. Okay, what you will do? New shares, old shares plus new shares. EPS, revised EPS. Okay, that you will do here. Okay, what will be the impact on the balance sheet? On the balance sheet, cash will rise plus share capital will rise with par value, right? Reserve will increase over and above, right? We will issue shares, share capital will rise, reserve will rise, cash will rise. But we are using cash to invest in non-current assets. So cash will fall and asset will rise, right? Plus you are making next year balance sheet. You are not making current balance sheet. You are making next year balance sheet. So what will be the impact? This return on asset will also become part of either receivable or cash. So your current asset will rise by return on asset. By return on asset. And you will remove previous earnings. Remove previous forecasted earnings. Add new earnings. Because previous forecasted earning is this, new forecasted earning is this. Earnings has been changed. So this will be the impact on the forecasted balance sheet. Forecasted balance sheet, not the current balance sheet. Forecasted balance sheet. But if you are making a current balance sheet, there is nothing about the forecasted balance sheet is given. So what will the impact? Share capital will rise. Reserve will rise. Obviously, cash will rise and fall, and non-current asset will rise. So in current balance sheet, that will be the impact. ठीक है, इसको अच्छी तरह देख लें, guys. This is important. I have written only the first transaction. Issue new shares. Invest in non-current asset. नया share, there is an increase in new shares, and whatever the money you will receive, invest in non-current asset, and return on asset will also rise. So what is the impact on the income statement first? There is an increase in EPS because of return on asset. Earnings will increase. Shares will also increase. So it depends, EPS will rise or not. EPS may rise, may fall. So what is the impact on forecasted balance sheet? Forecasted balance sheet means next year balance sheet. अगले साल की balance sheet, next year balance sheet. So what is the impact? Cash will increase, cash will fall. Cash will in, cash will out. Asset will rise, share capital will rise, reserve will rise. And it is the next year balance sheet. So the increase in return on asset will also become part of this balance sheet. So by return on assets, cash will rise and you will remove the previous year earning and add the new year earning. In INEA, this has been already tested. ये INEA में test हुआ. This has already been tested in INEA. Okay. Any question from this transaction? Anyone? Both. Both. Calculation will be tested and knowledge area will also be tested. Income statement aspect is just think what is the transaction? You are issuing the shares, you will receive cash. Issue share, receive cash, no impact on the current income statement. Issue shares, receive cash, and invest. In next year, your assets return will increase. That will become part of the income statement. Shares will rise. So because of the rise in shares, EPS may fall. Okay. And remember, if in exam there is a impact on the current balance sheet, every aspect will be same except the return impact. Because if you are calculating the impact on the current balance sheet, there will be no change on the retained earnings. There will be no change. There will be no impact of the return on asset on the balance sheet because you will receive return after 1 year. This is the current balance sheet. Earning will assumed to be same. Earning is not assumed to be same. This is already a forecasted earnings. And if you have invested in the non-current assets, earning is increasing. So how can you say that earning is assumed to be same? Earning will only change because of the return on asset. We are keeping rest of the scenario same. Okay, everyone. So in current balance sheet, there will be no impact of return on asset. Right? Okay. Now I'm writing another transaction and you have to identify the impact. Okay, guys, I have written 3 transactions. I am giving you like few minutes. I'm taking a pause for few minutes, and you have to calculate the impact. Like you have to assess the impact on all these three. First is issue new debt and invest in non-current asset and current asset. Second is issue new debt and buy back shares. Third is sale old asset, invest in new non-current assets and current assets. And whenever there is a change in current assets and non-current assets, there will be a change in the return as well. So these are 3 scenarios. Take a paper and try to write the impact on forecasted income statement, forecasted balance sheet, and if in examiner tests the current balance sheet. So okay, so I am taking a pause of few minutes. Meanwhile, you have to solve this. Issue new debt and invest in non-current asset and current assets. So if you issue in the new debt, increase in interest, but you have to take its after tax value. Okay, because of the increase in interest, earnings will down. Invest in non-current asset and current assets. So increase in return on non-current assets and current assets. So earning will increase. Revise earnings. Okay. Old shares, because shares will not change. EPS. Okay. Right. Okay. Let me tell you firstly the impact on the current balance sheet and then the forecasted balance sheet. So if there is a issue in new debt, non-current liability will increase. And if you invest in non-current asset and current assets, non-current asset will increase. Current assets will also increase. So balance sheet will be balanced. What happened in the forecasted balance sheet? These 3 impact will remain same. But whatever the impact on the earnings, that will also shift to the balance sheet. That will also shift to the balance sheet. So increase in interest. Either it will be a reduction in cash or it will be an increase in current liability. It's up to you. Increase in interest. Either it is an increase in current liability or it will be a reduction in current assets. So I'm just assuming it is a reduction in current assets. Then invest in non-current asset will increase the return. It will increase the return. So increase in return will become part of current assets. I'm assuming it will be part of current assets. And what about the retained earning? Remove old forecasted earnings, add new forecasted earnings. That would be the impact. Increase in interest only comes in forecasted balance sheet, not in the current balance sheet. ये बीच में लाइन लगी हुई है भाई, ये वाली क्या हो गया आपको? I didn't write here. Increase in it. Remember, the change in the income statement will only impact the forecasted balance sheet, not the current balance. Okay. Okay, now let me tell you the second transaction. So I need your help now in the second transaction. Okay, what was the second transaction, guys? 。 . 。  . 。 . 。 . 。 . . . . . . . . 。 . . . . . . . . . . . . . . . . . . . . . . 。 . . . . . . . . . . . 。 . . That was issue new debt and buy back shares. Buy back shares. So increase in interest is there. There will be no change in, there will be no increase in income. However, shares will increase. And you will calculate revised EPS. Okay. You will calculate revised EPS. Okay. Issue new debt. What will be the impact on the current balance sheet? Issue new debt. Non-current liability will rise. And you are buying back the shares. You are buying back the shares. Buying back shares mean share capital will fall. Reserves will also fall. Share capital will fall up to par. And over par value, reserve will fall. Reserves. So non-current liability will rise. Equity will go down. And what is the impact on the forecasted balance sheet? Share capital will down. Reserve will go down. Non-current liability will go up. And what is the other impact? What is the other impact on the forecasted balance sheet? Remember, in forecasted balance sheet, the change in the income statement also have an impact on the forecasted balance sheet. So change in the income statement will have an impact on the balance sheet. So what is the change here? Increase in interest. So increase in interest you can record in the current asset. Current asset will go down. Okay. And remove existing earnings, old forecasted earnings, add new forecasted earnings. That's how you will solve it. In all the questions, in all the question, it is very common. If there is a change in forecasted earnings, if there is a change in the earnings, that will become part of the forecasted balance sheet, not the current balance sheet. Remember, in only one question, examiner has tested the forecasted balance sheet. In only one question. Otherwise, in majority of the questions, examiner tested always current balance sheet. Okay, remember this. Okay, any question till now? कोई क्वेश्चन है किसी का? Is there any question, guys? Current balance sheet is today's balance sheet. Forecasted balance sheet is balance sheet after 1 year. So if there is an increase in return on asset, that will only impact the balance sheet after 1 year, not today's balance sheet. Actually, this is a balance sheet after 1 year. And this balance sheet includes the forecasted earnings. Balance sheet कब की है? If today is 2024, this balance sheet is 2025 or end of 2024. This is after 1 year balance sheet. So this balance sheet includes the previous forecasted retainer. this retained earning. This balance sheet includes this retained earning, previous forecasted earnings. But now you have changed the earnings. So remove the old forecasted earnings, add the new forecasted earnings. Balance sheet may, when if there is a next year balance sheet is given, that means that balance sheet already included the next year earning. But you have changed the earnings. So remove the old earnings, add the new earnings. ओके, समझ आइए वाली बात? यू गॉट इट? Current balance sheet is very simple. In current balance sheet, you will only calculate the impact on the asset and liabilities or equity. So what is the transaction? Issue new debt. Non-current liability will rise. Non-current liability will rise. Buy back shares. Share capital will reduce. And obviously up to the par value, share capital will reduce. And if you pay more than the par, reserve will remove or reduce. That's it. There is no other impact. Okay. Next transaction. Third one. So current forecasted earnings is given. So let me ask from Timothy. Please tell me what will be the impact of sale of old asset? And obviously you will receive funds, invest in new non-current asset and current asset. What will be the impact on the income statement? You have to tell. If you are selling the old asset, return will go down. Return will go down because your old asset was generating some value for you. No? The return will go down. But the good thing is you have invested that money in the new non-current asset and current asset. So return will go up. All should be on after tax basis. All should be on after tax basis. Okay, there is another profit and loss on the sale. Yes. Capital gain loss. That can also be part of this. And this is the forecasted earnings, revised forecasted earnings. Okay. Okay. Any question, anyone? we will add this to the retained earning as well. Okay. Now what will the impact on the current balance sheet? Current balance sheet. What is the impact on the current balance sheet? Anyone? बता सकता है anyone? What is the impact on the current balance sheet? Sale of old asset. Non-current asset will go down. Invest in new non-current assets. Asset will go up. Current asset will also go up. Okay. And can anyone tell what will be the impact on the forecasted balance sheet? इस पे क्या impact आएगा? Anyone? Now it is your turn. Please tell me. This will be same. Return of old asset and return on the new asset. The net of these will be have an impact on the current assets. And old forecasted earnings will be removed and add revised earnings. Okay. Everyone got it? Right? So now everyone please open the ENIA company question. ENIA company question. ENNEA. Page number 81. So this is the question. Okay. So please let me, I'm copying the balance sheet. So in this part, read the requirement, estimate and discuss the impact of each of the three proposals on the forecast, statement of financial position and earnings. Forecast, balance sheet and earnings. Forecast, balance sheet and earnings. Okay. Forecast, balance sheet. Remember, keep this into your mind. So now let me take the first impact. Increase the company level of debt by further 20 million borrowing and use the fund raised to buy back share. There is an increase in debt and reduce the share capital. Okay, this is the balance sheet, and this is the in the coming year India company forecast after tax profit for the coming year. ये क्या होता है? What is this, guys? This is forecasted earnings, 26 million. 6 million. Its current share price is $3.2. Non-current liability consists solely of 6% interest rate within 7 years. The term of the loan contract stipulates that an increase in borrowing, first case is increase in borrowing. Pehla case, increase in borrowing. First case is all about the increase in borrowing will result in an increase in the coupon payable of 25 basis point on the total amount borrowed. So on the total amount borrowed, you have to pay more 25 basis point. 25 basis point means 0.25%. While a reduction in borrowing will lower the coupon payable by 15 basis. Effective tax rate is 20%. Company estimated after tax rate of return on investment is expected to be 15% on any new investment. It is expected that any reduction in the investment would suffer the same rate of return. So guys, it is my humble request. Please read these two paragraphs again. Then I will start. Okay. So what is the impact? Anyone, please tell me. Anyone, please tell me what is the impact on the earnings? Anyone? Everyone can type. Everyone type. Zakim, Kader, Safia, Seni, Simona, Timothy, and all others. On the new loan, you have to pay 6.25%. But obviously, you will also get the tax savings. Okay. Plus 0.25% interest will be charged on the loan. 0.25% interest will rise by 0.25% on all the previous loan. What is the previous loan? 140 million. So on 140 million, you have to pay 0.25%. Please calculate the impact, guys. Everyone, please calculate. 20 into 1 million. 0.28. Is there any other impact? Guys, any other impact? No, right? Because you have borrowed and your debt will increase. It will increase the interest on the new loan as well as it will also increase the interest on the previous loan. Revise earnings. So what is the revised earning? $24.72. Okay. Okay. Shares will reduce. So what are the previous shares? 48 divided by 0.4. Previous shares are 120 million. And guys, you are borrowing 20 million and you are buying back the shares. You are borrowing 20 million and you are buying back the shares at $3.2. So how many shares you will buy? You have $20 million and you are buying back each year at $3.2. How many shares you are buying? 6.25. 6.25. 6.25 million shares will reduce. So what is the EPS? $0.2173. That is the impact on the income statement. Now, what is the impact on the balance sheet, on the forecasted balance sheet? You are borrowing 20 million. Non-current liability will increase by 20 million. You are buying back the shares by 20 million. Your equity will go down by 20 million. Right? Everyone, right? So your non-current liability will increase by 20 million. Your shares will decrease by 20 million. But what? Share capital will only change by 40 basis point. So how many shares you have bought back? How many shares you have bought back? 6.25 million. Up to the par value, you will reduce the share capital. 2.5 million. But sir, we have bought back the shares by 20 million. You are only showing the entry of 2.5 million. Share capital will reduce by 2.5 million. Remaining you will remove from the reserve. This will decrease by 2.5 million. And this will decrease by 17.5 million. 17.5 million. Look, balance sheet is balanced. Remember, up to the par value, entry will go to the share capital. And if you are buying back shares at above the par value, so how would you know that I'm buying back the share at above the par value? Look, par value is 40 cents, but you are buying at $3.2. So you are buying at above the par value. Na? Okay, this is the forecasted balance sheet. So you also have to post the change in the earnings. So this is 1.28. This is a decrease in income. Decrease in income means either reduce the cash or increase the current liabilities. So let's increase the current liability. 1.28. This is 38.28. This will be 45.5. Remove the previous retained earning. Previous retained earning is 26. Add the new retained earning, that is 24.72. Okay, all these will be same. This will be 45.5. Calculate the new retained earning, guys. 123 minus 17.5 minus 26 plus 24.72. 104.22. This will be 160. This will be 38.28. And inshallah, this will be 348. Please cross check. Balance sheet will be balanced. Can you explain the 2.5 share capital? Look, whenever you are issuing the share price is 3.2, par is 0.4. Up to the par value, entry will go to the share capital. Let's assume you are buying back one share. So share capital will reduce by 0.4. Retained earning will reduce by 2.8. So share capital will be debit, retained earning will be debit, loan will be credit, because you are borrowing and buying back the shares. But you are not buying back one share, you are buying back the 6.25 million shares. How many? 6.25 million, yes. So this will become 2.5 million. This will become 17.5 million. This will be 20 million. Okay? Okay. What is the logic behind share buyback? तुमने logic का क्या करना है? Follow the instruction. Look what he is saying. Increase the company level of debt by borrowing further 20 million and use the fund raised to buy back shares. Why you are putting logic here? Follow the instruction. Or you are asking generally. General पूछ रहे हो, क्वेश्चन में पूछ रहे हो? Generally देखो यहाँ पर भी क्या है? Actually you want to give some money to the shareholders. Uber जानते हैं? Everybody knows the Uber. Everybody knows the Uber, right? Uber, a company. Recently, Uber is buying back shares of approximately $7 billion. They have announced yesterday or day before yesterday. They will buy back shares up to $7 billion. Why? They want to give some return to the shareholder. They want to give cash back to the shareholders. There are two ways to give money to the shareholder. Either give the dividend or either buy back shares. If you give dividend, investor will expect that you will again give in the next period. But if you buy back shares, nobody will expect, it will not create the expectation. So that's why a company often do buyback instead of giving dividends. ठीक है. Okay. Now please you have to help me in the second part. Second part. Please tell me about the impact of second part. Debt is increasing by 20 million, but company is investing in the non-current assets. ठीक है. So what will be the impact? ये नहीं आएगा. This will not be there. What is the impact on the retained earnings? Sorry, what is the impact on the forecasted earnings? Anyone? Interest will remain same. Increase in interest both. But you are also investing in non-current assets. You are also investing in non-current assets. So if you are investing in non-current assets, your return will rise. Please read the question and tell me how much your return will increase. By 15%. It is already after tax, so there is no need to do anything. 3 million. So 24.72 plus 3. 27.7. Okay, yeah, please check. Now, what is the impact on the balance sheet? What is the impact on the balance sheet? Debt will rise, non-current asset will rise. Okay. But this is a change in the income statement. So that is approximately 1.72. There is a net impact of 1.72. Net increase in earnings. So increase in earnings is a positive thing, na? So either it will be increase in cash or decrease in current liabilities. Either it will be increase in cash or decrease in current liability. So let me put here. Okay. Share capital will remain same, but remove the previous earnings, add the new earnings. Now balance sheet will be balanced. Please calculate. Is it balanced? This is now 382, 302. 302. So 369.72. This will also be 369.72. ठीक है? Okay. Everyone. Okay, guys. Now, please tell me, can you do the third one? Anyone? So what is the impact now? Exactly. We can add the 1.72 impact, uh, increase in earnings or the change in earnings to the retained earnings. I'm just telling the very basic way. Obviously, if you get the concept, you can just um, solve the main part. No? Okay. What company has done? Company has sold the existing asset for 27 million. So cash in is 27. So disposal gain is 2 million. Cash in is 27. So what you will do? You will pay off the loan. Pay off the loan था क्या था? Company debt. Pay off the loan. So remember, if you pay back the loan, your interest will go down, right? Your interest will go down. Plus it is return. Reduction in borrowing will lower the coupon on the previous loan. Reduction in borrowing will also reduce the previous loan coupon. So what was the previous loan? If your payback the 27 previous loan is the remaining loan, right? So your 0.15 interest will save. Interest rate will decrease. कितना आएगा ये? बस. Is there any other impact, guys? Is there any other impact? By selling the asset. By selling the asset of 25 million for 27. This is disposal proceed technically. So is there any other impact? Anyone? Sale of asset आ तो गया. Disposal gain. There is no cash. There is no cash here. You have sold the asset and you use the proceed and pay back the loan. Guys, you have sold the old asset. So return on old asset, that will be deducted, na? Decrease in investment. So on 25 million, you will lose 15%. 3.75. So net will be 26 plus 2 plus 1.296 plus 0.136 minus 3.75. 26, 25.26, 25.682. देखो, from where are you getting this 27 million? Please tell me. From where are you getting this 27 million? So that means you had sold the asset. So what are the assets? Assets which are generating the income. So all the fund raised from the sale of the non-current assets. It is expected that any reduction in investment would suffer the same rate of return. If you are increasing the asset, you will earn. If you are decreasing the asset level, you will suffer. You will face loss. Asset आया तो income आई. Asset गया तो income जाएगी. If you are buying the asset, there is an income. If you're selling the asset, there will be a loss. Okay, now please tell me what is the impact on the balance sheet? Non-current asset, current assets, non-current asset is 282, current asset is 66, share capital, retained earning, non-current liability 160, 140. Debt will reduce by 27. Asset will reduce by 25. Okay. Any other impact? Retained earning will reduce by 26, add by 25.682. Or the net of all these three will either go to the current liabilities or the cash. कितना बनता है? It's a negative or positive? Net of all these. Or you can do separately for this and separately for this. ठीक है? Okay. Share capital is 48. Previous retained earning is 123. ठीक है? Okay. Right? So this is the only question in the past paper where examiner has tested the impact on the forecasted balance sheet. Otherwise, in majority of the questions, examiner has tested the impact on the current balance sheet. We can do it. We can do it. So get this idea. But to be honest, this information is very important. The above cases which we have discussed today. Thank you so much. Take care.